It's tax time, and this week's special guest on Beyond the Drywall is Jeff Cohen of Katz Cohen Certified Public Accountants. In this two-part interview, Jeff will be giving you insight on real estate accounting practices and just how you might want to set up your books. Be sure to like and follow us now so you won't miss a single interview. Hello, and welcome to Beyond the Drywall, the place where we talk tools, tenants, and truths about property management and construction. I'm your host, John, and tonight we have a special guest, Jeff Cohen from Katz Cohen Certified Public Accountants. And Jeff's going to be discussing real estate accounting and how you should set up your books. Jeff, thanks for joining us tonight.
Thanks for having me.
Well, so Jeff, let's just go ahead and jump right into this if you don't mind. Let's talk a little bit about you. How long have you been doing this?
Sure.
What do you do?
Well, I've been doing this about 30 years.
Okay.
Right now, probably about 15 years ago, I went out on my own, so I have my own firm.
Uh-huh.
I have about 10 people. We do all kinds of accounting and taxes, professionals, individuals, you name it, but we do specialize in real estate. That's probably 70 to 75% of our
Your
business.
corner, okay.
Yeah, so it's been, overall 30 years, but that's our story.
Pretty busy time of year for you then.
It's very busy. People ask me what we do outside of April 15th, and, I just laugh. I mean, the reality is, we've been doing tax planning for the last couple of months for all of our clients. We have now payroll coming up, 1099s. We can talk about that later, but a lot of people don't realize that your 1099s are due by the end of January. So we're quite busy with that today. I had a real estate client call me today. He told me that he has about 300 1099s to issue this year.
Okay.
Quite a bit.
Yeah. That's just one client. So you've got many more, multiply that. So, all right. Well, if you don't mind, let's talk a little bit about entities.
Okay, sure.
And how you might want to set that up.
Mm-hmm.
The differences being LLC, S Corp, C Corp, things like that. Mm-hmm. What do you suggest?
Well, it's the number one question I get is, help me with my structure. How should I be set up? And you may be in more than one entity, but the reality is it depends on what you're doing and the type of income you're generating. And so the government says if you're a landlord, if you're renting properties, you are generating passive income. And I've had clients with 20, 30 properties who said to me, why is it passive? This is what I do. And the answer is simple. That's what the government says. That's what the Internal Revenue Code says. So if you are landlording, as we say, or you own rental properties, that's automatically passive income, which means that there's no self-employment tax, and we'll get into that a little bit later. But the idea there is that there is no self-employment because it's not considered ordinary and active by the government, as opposed to what I'll give you some examples of what would be ordinary activity that would be subject to this extra self-employment tax. If you're rehabbing houses, so if you buy it, fix it up, and sell it, that's ordinary income, if that was your intent. If you're a property manager, that's an ordinary active business that's subject to extra self-employment tax. If you're a real estate agent, I have a lot of clients who own properties, but their main job is that they're real estate agents. So they're generating 1099 income. So if you're getting 1099, that's ordinary active income. So the IRS expects federal tax, your state expects state tax, you also are expected to pay Social Security tax. So it really depends what you're doing to how we would set this up.
Okay. And other cases for S Corps and C Corps would be?
Well, we got to delve into the differences between an LLC and an S corporation, but in some cases you can be either one, but there might be a tax benefit to being an S corporation versus
based on your activity.
An LLC, correct.
Okay. And are there other categories?
Well, you can own a property individually, right? Whether you're landlord or whether you're planning to fix it up to sell it. You don't have to put it in an entity. You can own it individually. There are, C corporations, depending on the state. There might be some other types of way to own property. People use land trusts. There's all kinds of, vehicles out there.
And what would be the benefit of any of those others?
So that's a great question. The thing that people don't realize is that the main purpose of the entity is not for taxes. The main purpose is legal. It's a legal issue. So if you want to protect yourself, asset protection, and you want to be protected if somebody were to file a lawsuit. So you own a rental property, the tenant trips and falls and sues you, right?
Then you're on the hook for it.
You're on the hook for it. So if you own it personally, you're on the hook personally. They can go after your personal assets as opposed to through an entity, an LLC, an S Corp, a C Corp. They're limited then.
Okay. Well, then that would make sense.
Yeah. So there's a legal aspect and a tax aspect.
Okay. What about on the accounting and bookkeeping side of things? How should things be set up? Chart of accounts, mixed use accounts?
Yeah, I mean, people call me all the time and they say, I'm just starting out, what should I do? What's the best way? Or I get, I've been doing this for a while and it's getting out of control. What do I do now? So it's interesting, and it really depends on who you are, how good you are with QuickBooks, for example, or your bookkeeping, how on top of it you're going to be, versus paying somebody else to do it, frankly. So if you have one rental property, could be that it's owned personally. There's no business involved. There's no LLC. There's no separate tax return for that. And so if it's a Schedule E, for example, as a rental property on your Form 1040, so when it comes to the bookkeeping, you might say, well, I know what the rental income is. I know what all my expenses are. Your preparer takes that information and runs with it. That, in some cases, that's all you need. What I see then is, one of my larger clients has 250 rental properties on his 1040. He's unable to track all that information by simply back of a piece of paper. So he's going to hire a bookkeeper. He has QuickBooks, and he's going to keep a reconciled set of records. When I say reconciled, what I mean is you're reconciling the bank accounts, you're reconciling the credit cards, you're reconciling the loans. Some people have payroll. You have to reconcile payroll. The idea of reconciliation is that you are making sure that you're not missing anything. And so if you know everything that went into this bank account, everything that went in through this credit card is being picked up, then from an accounting standpoint, everything has to balance. Okay. Now, when you talk about the entities, which we'll get back to, you have what's called a balance sheet. So on a 1040, when you have a rental property, I mentioned before, there's the income and the expenses, and that's it. It's pretty simple. It's straightforward. But if you have a business tax return, the IRS expects you to fill out a balance sheet. The balance sheet is assets and liabilities. That gets much trickier for non-accountant clients, right? So they don't understand how to reconcile and make sure that the cash is reconciled and all their assets, whether it's equipment or vehicles or the actual properties, along with the accumulated depreciation, the liabilities, the credit cards, the payables, etc. So that's where the bookkeeping really comes in. And so the more you have going on, the more I would suggest making sure upfront that everything is tracked and handled properly. Because once it gets too big, it becomes much more difficult to go back and fix it. And this is not just for real estate. This is for anybody. I mean, I have clients, I have people calling me right now and saying, I need you to do our books for the entire 2025 because they don't have any. And when I say to them, well, how much taxes should we be prepared to pay?
So these are the guys that kind of give it to you in brown paper bags, all the receipts, go, figure it out.
Yeah, well, that's how it used to be.
Yeah.
Now it's like, here's my logins, go figure it out.
Okay. Very good. So mixed use accounts.
Sure. When you're doing bookkeeping, so there's things like your regular expenses, right? You have a rental property, I have my utilities, I have my taxes, I have my interest, I have my repairs. But when it comes to expenses that can be personal versus business, which might include your telephone, your insurance, your auto expenses is the main one, right? It's your travel. So the question then becomes, from a bookkeeping standpoint, I get asked many times, how do I handle that?
Like what percentage was actually this? How much was actually personal mileage versus...
Exactly.
Yeah, okay.
And how do I track that within my bookkeeping? So there's various ways to do that. And so, you can say, okay, I'm going to book all of my auto, and then at the end of the year, I'm going to back out a certain percentage that is really personal. You can do the other way. You could say it's all personal, and then at the end of the year, come back and say, okay, here's either a mileage amount, I drove 10,000 miles for the year, or if you do have a specific vehicle that's 100% business, obviously, then all of that would be, counted towards the business.
But mileage can sometimes be a little fuzzy.
Mileage can be fuzzy, but I find it to be, in the end, the easiest way, because while you are supposed to keep track and logs, and the IRS, if they audit you, they will ask you to provide a log.
Sure.
I've had here...
And there's tracking software.
Sure.
Sure. I think one of them is, one of them, the way they pay for the application is they promote insurances or something, but it's a good mileage tracker that I understand that the IRS will accept.
Yeah, and people do that. I have a lot of clients that track their mileage, but a lot of people don't. And, as long as it's reasonable at the end of the year, generally speaking, the government will accept it.
What's reasonable?
Reasonable to your business. If you have one rental property and you tell them that I drove 30,000 miles related to my property, I don't think that they're going to...
No, it wouldn't pass the sniff test there. Yeah.
Not too reasonable.
Yeah.
But it depends on depends on the job. And again, this isn't just real estate. This is really any business.
Sure. Ratios and expense analysis. How do you go about that?
Well, again, that's the key to the bookkeeping. If you don't have a true reconciled account, you really can't, as a business owner,
accurately
analyze the information,
Right.
right? And so I tell people all the time, there's two purposes to the bookkeeping and to doing it correctly and accurately and staying on top of it. Number one is for your taxes. For me, if you're going to give me that information, I need it to be accurate and in good shape.
Do you ever get frustrated with some of your clients? I
don't know who's watching.
Yeah.
Of course, but I always joke, if I have 1,000 tax returns that I'm preparing, people are giving me that information in 1,000 different ways, and each person thinks their way is the best. That's just how it is. And so our job is to try to train them. This is the best way. This is how we want it, but it's not one size fits all. And so obviously I would like the information a certain way for my purposes and for tax preparation, but you also have the issue of, well, the owner of the company wants to be able to analyze the numbers. And so like recently someone sent me, a request, in QuickBooks, is there a way for us to do budget to actual? So we can put in an actual, I'm sorry, no pun intended, the budget, this is what we expect to happen, and then we want to be able to compare it to see where we went off, so that when we're pricing the next, property out, if they're doing a rehab, for example, we want to be able to price it better, so we can, turn a better profit. And so there's things like that which become important from the analysis side, and obviously any business, non-real estate as well. If the owner wants to look at and analyze percentages, how come my certain expense could be anything. My telephone expense is up 30% over last year. Why is that? And then maybe they're going to dig in there and find something. You know what I mean?
Okay. So let me just change the subject just a
Sure,
little bit.
yeah, no
What are the benefits of being classified as a real estate professional?
So the way I like to explain that really goes back to the whole active versus passive discussion.
Okay.
I mentioned before that it's the self-employment, the Social Security, which is 15.3%. That is really the main reason why you need to be careful between the ordinary side, what I call the active business side, versus the passive. Okay, so if I'm renting property, I mentioned before, I'm a landlord, I'm not going to pay that extra 15%. But if I, generate 1099 income or I rehab a house, it's ordinary activity, I'm going to generate that extra 15%, that Social Security tax. There's also, so that gets into the entity discussion. Should I be an LLC? Should I be an S corporation? And again, we still have to, get back into that. But as far as the classification goes, if I have a day job, for example, and the IRS says you're more than 50% of your time is spent on that job as opposed to in your real estate, you can't meet this real estate professional test. The idea of meeting it is to be able to claim losses against other income. And so say I have a day job and I make $500,000 a year on a W-2, for example. I'm a doctor, I'm a lawyer, and I also have these properties as an investment. What everybody wants to do, the name of the game, is to take the losses from the properties and offset, right? Because you get depreciation, you get a lot of goodies in the real estate world. So you want to offset your ordinary income in order to lower your tax bill.
Right.
That's the idea. And the IRS pretty much says if you're not a real estate professional, you can't do that.
But
if your income is over a certain level, if your income is over that level, but you have, you meet these two tests for a real estate professional, more than 750 hours, which is pretty, easy to hit, but more than 50% of your time in real estate. And most tax court cases have come out and resulted in that if the individual has a day job, they're out.
Really?
Yeah. Now, I've had plenty of people swear up and down that I have my day job, but I spend more than half my time on the real estate. And so there's what you have to weigh, when it comes to that. But there's really three levels. There's the bottom floor, as I call it, which is completely passive, which means if I have losses, they're passive, I can't take them. The middle floor is where I'm actively involved, but I don't meet the real estate professional tests. But I can get something if I make less than $150,000. Okay, so from 100 to 150.
From both?
What's that?
From multiple sources?
Yeah, it's your adjusted gross
income.
That's the limit.
That's the ceiling.
Okay. So between 1 and 150, you get a $25,000 kind of deduction that gets phased out. 2 for 1. So once you hit the 150, it's gone. And so if you make 250,000, it's husband and wife and your joint return. Each of you are making 100,000 from your job. You're not going to get this loss to offset the other income, unless you are a real estate professional. And so then the questions come up. Well, one spouse doesn't work. Can we say that spouse is the real estate professional? And so there's a lot of ways to plan for this.
Just getting a realtor's license, not enough to
really
say I'm a professional. Wow.
Yeah, and let's say I have clients who are roofers, appraisers,
right.
Other things that have to do with real estate, but it's not direct. And then they ask me that question, well, am I considered a real estate professional?
Wow. So, okay, good to know. And how does that impact, say, retirement planning?
Well, again, retirement planning depends on earned income. You can only do a retirement contribution if you have what they call earned income. Rental income is not considered earned income. You can have $1 million of rental income, and technically you can't do a retirement contribution on that. So, the number one question I get is, how can I reduce my taxes? And the number one answer is, if you're making a lot of money, put money away into retirement and get that deduction. You have IRAs, you have SEPs, you have 401ks, you have cash balance plans. There's multiple vehicles to put money away. The government is promoting people to put money into retirement accounts, right?
And should you look at that by tiers of income or by
I mean, how should you develop a strategy for that?
Yeah, I mean, I have clients who their number one goal in life is to save for retirement. And I have other people, especially real estate folks, who say my retirement nest egg is my property. So everybody's different. But if you're looking for a tax deduction, retirement contributions are up there with anything, because there's the potential to put away a lot of money and take a tax deduction for that. But you have to have earned income. And so everything kind of comes full circle back to the entity discussion as to what type of income, what's the character of income, what I'm doing, and how is it taxed, and how should I be, what entity, should I be using, and then from there, kind of figure out all of these other issues.
Thanks for watching, and be sure to come back for part number 2 on Beyond the Drywall.